things to point out here is that Jeremy Hunt has already said this fall in inflation could potentially open the door for a rate cut. So when are we going to see it, and is that something that the BOE could perhaps signal today?
It's quite likely, actually. The thing is, there is this trend of central banks basically shifting their monetary policy now. The reason for that is they've seen enough disinflation. They had seen enough disinflation in the US. Now they are seeing enough disinflation in Europe to signal, just like the ECB has done it, signal that now they are trying to bring a better balance between growth prospects and inflation prospects. The emphasis was mainly on inflation so far on the European side. Now things are shifting progressively to what the Fed is trying to introduce, meaning preemptive pivot. That's our expectation for this BOE meeting. The print of inflation of yesterday is ground enough to see a cut happening already over the summer.
Indeed, Florian, and that has been enough to, let's say, revive some animal spirits when it comes to risk assets across the UK and broader Europe. What's your investment strategy in the UK and the continent right now? How should we be reading this situation?
We like at the moment European assets broadly, and the reason for that is that they were the laggards of 2022 and 2023, but now that we're seeing central banks shifting sides from hawkish to dovish, now that we're seeing the US dollar also retreating somewhat, we're starting to seeing value in UK stocks and value in European stocks. We're starting to seeing also value in emerging equities, emerging credit. Broadly speaking, there is a shift at the moment from the US towards whatever was behind before, meaning smaller caps, emerging Europe and UK.
Walk me through what we're seeing in Asia right now, particularly after this historic decision from the BOJ to walk away from easy monetary policy. We've seen Japanese risk assets rallying, the Nikkei 225 hitting a fresh all-time high, but the yen sliding a little here. So what's going on in Asia? How are you thinking about asset allocation in that part of the world?
The decision of the BOJ was to some extent disappointing with respect to expectation. We've seen a trend, a hawkish trend over the past 18 months or so, and investors were expecting that the BOJ would embark on the same trend at some point. Now, probably that meeting was the last checkpoint to do something hawkish, somewhat hawkish, which they did, exiting from negative rates. This thing is done. We're not expecting much more actually decision from the BOJ. We expect the BOJ to keep on surfing this fantastic wave. They've been hoping for inflation for years. This inflation is currently getting delivered. It's quite moderate. Wage growth is about 2%. That's pretty much the sweet spot of inflation. So all of that makes of Japan today a nice, let's say, investment place. We've had an overweight in some of our portfolios for Japanese assets, and we keep on having them. We're seeing Japan at the moment as the sweet spot of Asia in the waiting for China to show signs of improvement.
Indeed, a normalization of policy is good news in Japan. You mentioned China. What's the strategy there, given the volatility that we've seen in stocks?
Everything in China at the moment is related to the position of the Chinese consumer, in our opinion. The Chinese consumer has played a large role last year, meaning it disappointed markets during the reopening of China, and now it's showing signs of an improving trend. At the moment, we're collecting about 70% of improving data when it comes to the Chinese consumer, and we see that as a positive for Chinese stocks. But we need, of course, to see that trend going on, showing confirmation before being sure to go back to China as a place to play in the emerging realm. For that, we need data confirmation, and of course, this leaves behind this housing situation that needs to find a solution also.
Indeed. Investors watching that situation very closely. Florian, just before I let you go, let's just finish up on a note on the Fed here. What did you make of the decision to maintain this expectation around 3 cuts for the rest of the year? And that also coming despite the fact that we see higher inflation and a higher growth forecast coming out of the Fed as well. Are they going to be able to cut 3 times in the United States this year, or is that still maybe a little bit misaligned with market expectations?
You're right. You could summarize the meeting by saying better growth prospects, same rate cut plans. And that has made markets very happy, especially on the equity side. One point was very important, in my opinion, during the Q&A session to answer your question. What Jay Powell said is like, we are looking at cracks in the job market that could trigger us to cut rates faster than expected. And when asked whether the buoyant job market would do exactly the converse to the Fed's policy, he denied. He said, if the job market remains buoyant, we will keep on cutting rates 3 times this year. I think it's a very strong message in terms of asset allocation, in terms of financial markets globally. The Fed put is well, and Jay Powell intends on using it as much as possible in this year. We should get the 3 cuts in spite of inflation, in spite of a solid job market, in spite of improving growth conditions. All of that creates a fantastic environment for risky assets if you don't mind too much about valuations.